Good morning. I'm David Wessel, Director of the Hutchins Center on Fiscal and Monetary Policy at the Brookings Institution. I want to welcome everybody to today's event. After a long stretch of below target inflation and interest rates that were hovering close to or even below zero, both the Federal Reserve and the European Central Bank have revised their monetary policy mandates in ways that may seem insignificant to the uninitiated, but are quite significant to those who follow central banking closely. In August 2020, the Fed redefined its definition of maximum employment and launched what it calls flexible in average inflation targeting, which, among other things, aims at following periods of below 2% inflation with periods of above 2% inflation. And more recently, in July 2021, the European Central Bank tweaked its goal, which had been inflation close to but below 2%, to what it describes as a symmetric 2% target. Today, we want to ask if the new frameworks are well understood by the markets and the public, whether the central banks in Europe and the United States have communicated them adequately, and how well these frameworks are holding up in what amounts to a very unusual stress test, a surge in inflation as the global economy recovers from the COVID-19 pandemic. We're happy to take your questions on Slido, that's a URL sli.do, or on Twitter, hashtag Fed Framework, or by email at events@brookings.edu. Our event today will come in two parts. First, we'll have presentations by Rich Clarida, Vice Chairman of the Federal Reserve Board, who was very key to the writing of the new framework. Then by Phil Lane, who's a member of the Executive Board and Chief Economist of the European Central Bank. And then by my Hutchins Center colleague, Ben Bernanke, former chair of the Federal Reserve. That panel will be moderated by Rachna Shambho, who's the finance editor for The Economist, and who, among other things, has previously worked at the Bank of England. And then we'll have a panel of Fed watchers, which I'll introduce later in the program. So with that, I'd like to turn it over to Rachna.
Thank you, David. One of my tasks today was to introduce the panel, but they don't really need any introduction. I'll just tell you a little bit about the structure of the next 50 minutes. We'll have Rich Clarida and Philip Lane both presenting for about 10 minutes on changes to their framework, how well they think the frameworks are understood by the public, the markets, businesses, and politicians, how well they think the framework is faring given where inflation is today. And then those presentations will be followed by a presentation by Ben Bernanke, conceptual sort of thoughts on conceptual differences between the two frameworks and how he thinks they've been faring. And then we'll have about 20 minutes for a group discussion. Rich, over to you.
Thank you, Rachna. The US economy in the second quarter made the transition from recovery to expansion. Few forecasters could have expected that the recovery would be either so robust or as rapid. In retrospect, it's clear that timely and targeted monetary and fiscal policy actions provided essential and significant support as the recovery got underway last year. The recovery that commenced last year was quite robust, and with one quarter to grow, GDP growth this year is projected by the Fed and many outside forecasters to be the most rapid since 1983. Moreover, under the median projection for GDP growth in the September SEP, the level of real GDP returns to its pre-pandemic trend growth trajectory by the fourth quarter of this year, which, if realized, would represent one of the most rapid such recoveries in 50 years. In the September projections round, my individual projections turned out to be quite close to the path of the SEP medians. Under these projections, GDP growth steps down this year to around 4% next year and further in subsequent years towards trend. Not surprisingly, above trend growth in GDP translates into continuing declines in the projected path for the unemployment rate, which is projected to fall below 4% next year. This modal projection for the unemployment rate is certainly consistent with a rebound in labor force participation to its estimated demographic trend. And it's also consistent with cumulative employment gains that by the end of next year eliminate the 4.2 million employment gap relative to the previous peak. My projections for headline and core inflation are, alas, also similar to the median SEP projections. Under these projections, inflation surges this year to at least 3.7%, more likely now with new data, probably 4%, before reverting back to about 2.25% next year. Thus, the baseline outlook for inflation, shared with many outside forecasters, is that under appropriate policy, most of the inflation overshoot relative to the longer run goal of 2% will in the end prove to be transitory. But as I've noted before, there is no doubt that it is taking longer to fully reopen a $20 trillion US economy and really a global economy than it did to shut it down. Although in a number of sectors of the economy, imbalances between demand and supply are substantial, I do judge that over time they are likely to dissipate, and to do so without putting persistent upward pressure on price inflation. But let me be clear on 2 points. First, realized inflation so far this year represents to me much more than a moderate overshoot of our 2% longer run goal, and I would certainly not consider a repeat performance a policy success. Second, as always, there are risks to any outlook, and I and at least a dozen of my colleagues in our SEP projections indicated that the balance of risk to inflation are to the upside. Turning to the framework, in September of last year, the FOMC introduced and since then has reaffirmed outcome-based threshold guidance that specifies 3 conditions the committee expects will be met before it considers raising the target range for the funds rate. This guidance brought the statement into alignment with our new flexible average inflation targeting framework adopted in August of last year. The quote from the FOMC statement, the conditions are, quote, labor market conditions have reached levels consistent with maximum employment, and inflation has risen to 2 and is on track to moderately exceed 2% for some time. Now, while we are clearly ways of raising interest rates, if the outlooks for inflation and unemployment I summarized a moment ago turn out to be the actual outcomes, then I do believe that these 3 conditions for raising the target range for the funds rate will have been met by year-end 2022. Core PCE inflation since February of 2020, a calculation that smooths out base effects and also measures the average rate of inflation since hitting the ELB in March of last year, is running at 2.8% through September and is projected to remain moderately above 2% in all 3 years of the projection window. Moreover, my inflation projections for 2023 and 2024 would certainly, to me, satisfy the on track to moderately exceed 2% for some time threshold. Finally, while my assessment of maximum employment incorporates a wide range of indicators to assess the state of the labor market, the employment data I look at, as is well summarized by the Kansas City Fed's Labor Market Conditions Index, are historically highly correlated with the unemployment rate. And my expectation today is that the labor market by the end of next year will have reached my assessment of maximum employment if the unemployment rate has declined by then 2 or below 4%, as in the projections. Now, given this economic outlook, so long as inflation expectations remain well anchored, which I judge at present to be the case, a policy normalization path similar to the SEP median dot would, to me, be entirely consistent with our new flexible average and targeting framework, and as well the policy reaction function I discussed in remarks here at Brookings exactly 1 year ago. In the context of our new framework, it's important to note that while the ELB can be a constraint on monetary policy, the ELB is not a constraint on fiscal policy. An appropriate monetary policy under the new framework, to me, must and can incorporate this fact. Indeed, under present circumstances, I judge that the support to aggregate demand from fiscal policy, including the more than $2 trillion in accumulated excess savings, in tandem with appropriate policy, can fully offset the constraint that the ELB imposes on the ability of inflation targeting monetary policy acting on its own to restore maximum employment and price stability while keeping inflation expectations well anchored. Before I conclude, let me say a few words about our Treasury and MBS purchases. In our December FOMC statement, we indicated that we would maintain the pace of our purchases until, quote, substantial further progress had been made towards our goals. At our FOMC meeting last week, the committee agreed that the substantial further progress standard had been met, and we decided to begin reducing the pace of our purchases by $10 billion per month for treasuries and $5 billion per month for agency MBS. The committee judges that similar reductions in the pace of our purchases will likely be appropriate in future months, but it is prepared to adjust the pace if warranted by changes in the outlook. Thank you very much for your time and attention, and I look forward to the conversation with Ben, Phil, and Rachna. Thank you.
Thank you very much, Rich. Philip, over to you.
Okay, thank you, and good morning, everyone on that side of the Atlantic. So our strategy review, of course, faces the same basic environment, in particular the implications of a low equilibrium real rate for monetary policy. But because it's been 20 years since the first review, there were a lot of other tasks to take on. So as David mentioned in the introduction, it was important to clarify that the inflation target is indeed 2%. And when we say symmetric, it's symmetric in terms of finding deviations on either side to be equally undesirable. So it's a statement about our preferences. We also, were concluded in a way that's, of course, based on the same family of conclusions as the Fed, that with the effective lower bound, it's important to take that into account in monetary policy. So in other words, even if preferences are symmetric, the world out there is not symmetric. There is an effective lower bound. So in terms of how monetary policy responds, that's important to take into account. So what does that mean for us? It means, first of all, in terms of our toolbox, to make clear that it's not only a question of using the interest rate, it's a question of using forward guidance, it's a question of using asset purchases, and it's a question of using long-term refinancing, including targeted operations, which are especially relevant for our bank-based system. So first of all, with a lower bound, step number one, expand the toolbox. Step number two is to be clear that essentially if there's a lower bound constraint, what it means is monetary policy needs to be forceful or persistent in the neighborhood of that lower bound. And of course, if the steady state equilibrium real rate is low, you're basically nearly always near the lower bound in that sense. So we had a situation where we concluded that in order to stabilize inflation at 2% over the medium term, it is important to have a full toolbox, and important to be willing to sign up to forceful or persistent policies. And to be clear that this may imply a temporary period where inflation is moderately above zero. So these policies, in terms of thinking about the kind of inflation path, may well generate transition paths where for a period of time, inflation is temporarily above 2%. Now, let me mention, of course, it's an interesting topic to think about is the similarities and differences to flexible average inflation targeting, because we did conclude we would not temporarily move the target. We keep the 2% target, but it's important to be clear that the pathway to that 2% in the medium term may involve that kind of temporary period of overshooting. Maybe what's interesting is when you think about, well, how do I translate a determination to be persistent near the lower bound into a rate forward guidance? Where we ended up actually, we think actually caters quite well to this kind of supply shock that we're currently facing. Because we say, well, and honestly, let's also say that where we ended up was a midpoint between the traditional forecast-based monetary policy and then outcome-based monetary policy. So what we ended up with is a blend of the two approaches. So in terms of the forecast-based approach, we pulled forward the kind of timeline where we need to see 2%. So we need to see 2% well ahead of the end of the projection horizon. So we're not going to rely on forecasts 2 or 3 years from now, which are obviously going to be much more uncertain than forecasts that are more near-term in nature. But very importantly for today's situation, we also insisted on durability. That it's not enough to hit it on a transitory basis. It also has to be projected to last throughout the rest of the projection horizon. And of course, right now, when inflation is temporarily high, and when our projection horizon in the next forecast around December will include 2024, this is why we do say, and by the way, I had some remarks in an event earlier today where I reiterated this. We do say we think inflation is high right now, it's going to fall through the course of next year, and we remain confronted with weak medium-term pressure, not excessively strong medium-term pressure. And then the third element is we do need to see the outcome. You know, it's not just a case about the forecast. And so for us, we need to see realized progress in underlying inflation. And one point I was making today was essentially, of course, measuring underlying inflation right now is difficult because with the pandemic, with bottlenecks, and base effects, that simple approaches such as looking at core inflation is not going to work because there's temporarily high goods inflation, there are temporary bottlenecks also in the labor market. So, but I do think with those appropriate adjustments, the forward guidance that we have is telling you quite a bit about how we're going to make policy. Let me just mention, because of course the mandates are different between the Fed and ECB. But throughout our strategy is we focus on the medium term. And historically at the ECB, one basic reason to look at the medium term is it does allow us to take into account factors such as employment. So clearly, you know, if you try to tighten monetary policy in response to an adverse supply shock, in terms of weighing up the kind of pros and cons of that, and looking beyond the price stability criterion, it's important to take into account the adverse effects, side effects on employment. So, you know, again, when we think about similarities and differences across mandates, our medium-term perspective delivers quite a bit. So I'm not too sure if how much I'm running out of time, but let me mention maybe two other factors, which of course are, one is on financial stability. I mean, the Fed also had to take this on, but I think we were also clear, and depending on the circumstance we face, it's important to think about financial stability. And of course, the pandemic represented a particular version of that, which is it was so important last year to make sure there's enough financial or monetary policy response to rule out adding financial instability on top of pandemic instability. Let me join Rich Clarida in terms of emphasizing the fiscal role at the lower. I mean, by the way, people looking for the ECB strategy, we do have a 2-page high-level statement, but the Governing Council also wrote an 18-page outline or overview, which includes some paragraphs on fiscal policy, where we do say fiscal policy can play a very important counter-cyclical role near the lower bound. And we also released 18 occasional papers where there's even more material from the staff on fiscal monetary interactions. Okay, and then maybe just finally, we also covered, of course, climate change, because looking ahead over the next number of years, and of course, while COP26 is still going on in Glasgow, it's all important to mention when we do think about the environment we face for the next number of years, the transition to a lower carbon economy is clearly going to be a kind of macro relevant factor shaping economic dynamics. And therefore, I think we've highlighted that, but as an analytical challenge to be on top of that, the macro implications, which are non-obvious, but also in terms of our toolbox, making sure our corporate sector purchase program, our collateral can be shaped or reflect the risks associated with high carbon sectors. So again, I could say more, but maybe I'll just stop there. Thank you.
Thank you, Philip. Plenty of food for thought, and I'm sure we'll pick up lots of that in the discussion. Now over to Ben.
Thank you. I'm impressed with the progress that's been made in articulating policy frameworks by both the Fed and the European Central Bank. Good frameworks help to make policy more coherent, more transparent, and more credible. In my few minutes, I'm going to raise some questions I hope will stimulate the discussion, but given time, I'm not going to ask for immediate responses from Rich and Philip. Instead, I'm going to leave it to the moderator to guide the discussion. First, both the Fed and the ECB reviews were motivated by the constraints imposed by the effective lower bound, or ELB, and the concern that under previous frameworks, the ELB would result in inflation remaining most of the time below target. To offset that downward bias, you can either adopt a policy of systematically overshooting the target after a period of low inflation, as the Fed has done, or you can avoid intentional overshoots, but simply try to return inflation to target relatively more quickly when inflation has been too low, which appears to be the ECB's approach. To Philip, is that a fair description of the ECB's strategy? Now, isn't there a problem, though, that precisely because of the ELB, the ECB has recently not had a lot of policy space, so that an accelerated return to target from below will not always be feasible? For Rich, in its new framework, the Fed is actually trying to offset the downward bias in inflation in two different ways. First, by aiming to overshoot the inflation target, and second, by issuing preemptive strikes on inflation. That is, by not raising rates until full employment is achieved. The overshooting strategy is flexible. Since the size and the duration of the overshoot are not specified, they can be calibrated as needed to ensure that inflation expectations are anchored at target in the medium term. However, although I support the new emphasis on maximum employment as a broad-based and inclusive goal, there seems to be a missing degree of freedom here. In particular, there's no guarantee that avoiding preemptive inflation strikes and anchoring medium-term inflation expectations at target will always be mutually consistent objectives. How will the Fed deal with any potential conflict? On this topic, and Rich already made some allusion to it, any further thoughts on how the Fed will determine where we are when we are at full employment in this very unusual environment would be, of course, quite welcome. I've noted the advantages of policy frameworks which, like forward guidance in general, are intended to clarify the central bank's reaction function. A drawback of explicit guidance, however, is that it's impossible to specify all contingencies in advance, which can result in miscommunication. The pandemic recovery has involved many unexpected developments, including larger than expected fiscal packages in the US and supply chain problems globally. For both the Fed and the ECB, what's the general strategy within the formal framework for dealing with and communicating with unexpected contingencies? Monetary policy has had to contend with the fact that many key variables are not directly observable, including the natural unemployment rate and inflation expectations. Let me ask about one other hard to observe variable, the neutral interest rate. Once rate hikes begin, the neutral rate will be an important determinant of how far and how fast they go. But R star is as an uncertain guide, guiding by the stars, as Jay put it, as uncertain as U star. For example, the Fed's estimate of 2.5% nominal neutral rate is higher than what markets imply, although I think the ECB's estimate is lower. How should central banks deal with the uncertainty about the neutral rate in calibrating policy and the pace of tightening? And finally, in this sort of hard but short list of questions, I'm interested in the comparability of US and Euro area inflation measures. We're talking about 2% as if it were a constant of nature. But the Euro area inflation numbers exclude housing, which is one of the planned reforms, is to add housing to their indicator. And the role of government in health and education, two big parts of the consumer basket, are very different in Europe and America. Have either of you looked at the mapping between US and European inflation measures? Are the targets really the same? Those are just a few, I think, difficult questions, but I'm sure we'll have plenty of time to talk about a variety of issues, and I look forward to our discussion. Thank you.
Thank you very much for all of your comments. Now we are open to a bit of a discussion. I propose that I have a few questions of my own. I'll sort of mingle them with Ben's very difficult questions, which might be a bit of a relief to Rich and Philip, because mine are much easier, I'm sure, to answer. Perhaps, Philip, if we start with you and Ben's question on policy space and whether whether the ECB has enough room to achieve its new tweaked target.
Okay, no, I think that's a very important topic, and of course, when a strategy is written, it's intended not just be facing today's situation, but as a guide for the next number of years. And this is why we say we do think near the lower bound, policies should be forceful or persistent. And the idea is, so let's say we're back at 2% inflation. Let's say, but R-star is very low. So that essentially the steady state interest rate is not that far away from the lower bound, i.e. it's a constraint in the sense of just using interest rate policy may not be enough if you have a very large macro shock. I mean, I think there's a general principle there, which is let's be forceful. Let's not get down to the lower band. And this is, I think, what Ben was saying, look, let's be speedy. Let's, when you do have that kind of risk factor, preempting the drift down to the lower band would be a good idea. So acting forcefully to make sure you don't find yourself in a situation of persistently being too far below 2%. That's honestly, that's going to be very important for the future. But right now, when essentially for various reasons, we've ended up having used up a lot of the policy space in terms of the policy rate. Having gone to negative 50 in terms of the deposit rate. This is where the persistence comes in. So that essentially, we do think it's important to be clear that the patience required in making sure, because of course, as inflation, I mean, quite often an inflation projection basically says it's going to take some time, but every year inflation is going to go up. It's going to converge back towards the target. So if you hold the policy rate constant and every year inflation is creeping up, but then essentially the real rate is becoming more negative, which in turn is supporting the inflation dynamic. So if you're persistent in holding down the nominal yield curve, then that will be helpful in helping the overall convergence. What I would emphasize though, in our case, probably even more so than the Fed, or maybe not so differently to the Fed, it's important to recognize that the role of interest rate policy can be reinforced through enough QE, and for us, targeted lending, where including the use of dual interest rates. And of course, it doesn't hurt if fiscal adds to that by also being countercyclical. And maybe just on the other point Ben mentioned there is I didn't get it in my opening remarks. We do think the European price measure should be revised to include a greater weight on unoccupied housing. By the way, we made a different choice to the Fed. It's less about equivalent rents for owner-occupiers and more about the price index, where actually a large weight on it is essentially repairs, renovations, construction costs, but it also has a little bit of weight on house prices. And there's pros and cons of different approaches. But right now, I mean, this would mean a higher inflation rate than we're currently seeing. There's no doubt about that. But we do have to, first of all, be clear at any point in time that we're targeting the official measure. So we do have to wait until that revision is made, which is going to be a multi-year project for Eurostat and the European system. It's very interesting to think about cost of living, to think about, because of course in Europe, a lot of goods are supplied by the public sector. I don't have to spend money to have access to publicly provided education and health, but clearly it's relevant in terms of the overall economy. So those are very interesting questions as well about how to think about inflation. And I do think, honestly, though, I mean, these will take on more and more importance as inflation stabilizes at 2. I mean, I think regardless of which precise measure you're targeting, when you do have this, and this morning in the other talk I gave today, between 2014 and 2019, inflation in the euro area averaged 0.9. So 0.9 is below 2. It's below any other measure you may want to think about. Now, when the gap closes and we no longer have this super low inflation problem, it's a reasonable debate to refine the measure. But for right now, the bigger question is to make sure we restabilize at 2%. So let me stop there.
Rich, I wondered if I could ask you, what does it change that you're now approaching the target from above rather than you might have expected when you spoke last year to be approaching it from below?
It's a great point, and as Ben alluded to, a key element of our new framework, even absent supply shocks, is to offer guidance at the ELB that liftoff is delayed till you're actually at 2, and the committee has some comfort that at least you're in the vicinity of maximum employment. We don't observe it precisely, so it's actually a feature of the new framework that you would be approaching from above, because you're delaying liftoff and there's some inertia, and there will likely be some inertia in the liftoff path if history is any guide. The difference that we did not anticipate is the depth and the breadth of the global supply shock. Adverse supply shocks, are a fact of life for monetary policy. It's been a while, maybe in the U.S. since the 1950s, since you've had such a huge supply shock, good versus services, and now global commodities. In the existing framework, we made changes. One thing we didn't change is what's in paragraph 6, which talks about how we'll deal with supply shocks when the maximum employment and price stability legs of the mandate are in conflict. And it essentially says that that's a difficult trade-off to make, and we're going to look at the relative gaps and how long it would take to restore both of those. So I think in the narrow question, the new framework anticipated, and look at the simulations and Bernanke, Kiley, Roberts, which were a key influence on us, some approach from above. What's complicating this is this year, or the breadth and the enormity of the supply shock. If I could just briefly, because Ben raised this, and I'm sure it's implicit also in your question as well, Rashna. So obviously the Fed is a dual mandate central bank, in contrast to many in the world. And so in particular, we focus on the labor market as opposed to some broader concept of slack, for example, at other central banks. And that's appropriate, since Congress has said we're not to focus on slack, but on the labor market. Maximum employment, we've said, is broad-based and inclusive. In effect, what that means to me, and what I've said here at Brookings and other places, is that history shows that if you can get a fully employed labor market that's consistent with price stability and keep the labor market there, the longer you're at a healthy labor market, the broader and deeper are the gains to different groups in society. Obviously, we don't have a well-stocked toolkit to deal with every labor market indicator, but broadly, my sense is if we get the unemployment rate down in the vicinity of what we think of as U star, and we keep the economy there, that the benefits will be broad-based and inclusive. But importantly, and let me emphasize, maximum employment is the level of sustained employment consistent with our price stability goal. And everything in the new framework is in service of well-anchored inflation and inflation expectations. And certainly my view is that there's not a particular number we're aiming for regardless of inflation. In terms of what we look at, I think it's important in the labor market to not only look at quantities, but at prices, and in particular, unit labor cost and wages adjusted for productivity. One of the remarkable features of the economy last year is we had the most severe recession, arguably since the Great Depression. And we had an unemployment rate that rose briefly to 14%. And yet, if you look at the Atlanta Fed wage tracker, for those households and workers who kept their job last year, there was really no material slowdown in wage inflation. So that was a policy success. But what it does mean is coming out of the recovery and now into the expansion phase, the labor market, if you look at wages adjusted for productivity, is certainly much closer to where it was, say, in 2017 than it was in 2011 or 12. And so that's going to be, to get to Ben's point, very relevant to me, are cost adjusted for productivity broadly in the labor market. So thank you.
Thank you. Ben, would you like to come back on either of Rich or Philip's points?
No, that was very helpful. I mean, I think Philip is right that you need an asymmetric reaction function, that you need to be more aggressive at avoiding the lower bound. But I just note that, you know, before the pandemic, that the ECB, whose policies I found, you know, extremely interesting and well coordinated, was having a great deal of difficulty getting inflation expectations up, and their framework relies on moving more quickly when they start from near zero. So that was my question. I think that maybe Philip can comment. It seems to me that where they are now is actually in many ways closer to where the Fed was in 2012, with a symmetric inflation target and an effort to maintain inflation expectations at that level. The Fed has gone to a somewhat different approach that involves intentional deviations from the target. So I think there is a substantive difference there, and that the zero lower bound will remain a concern after we get through this unusual period.
Would that be a parallel that you agree with, Philip, that the ECB now is like where the Fed was in 2012?
Maybe partially, but I mean, we do recognize the asymmetry, and maybe the Fed in 2012, I mean, was clear about the inflation target. And it really boils down to this asymmetry between how much, and again, you know, I think our review was certainly informed by a lot of model-based simulations, you know, of course, which was also heavily used by the Fed. And the question is, when you look at the trajectory with the kind of fate type structure, where you do say, well, you know, I'm going to intentionally overshoot, versus a commitment to be persistent, which may imply a temporary period of overshooting, whether this really makes a dramatic difference. And let me emphasize again, when you supplement with enough QE and enough targeted lending, so, you know, just doing the simulation with one policy measure, which is forward guidance, it is really, I think, and let me emphasize again, maybe most basically, is when we think about the initial conditions facing us versus facing the Fed, you know, the initial condition for us, which is basically a long period of inflation around 1, if not a nudge below 1, you know, talking about the kind of extra target, if you like, the temporarily elevated target above 2, compared to, you know, this is something obviously super relevant when you're already quite close to 2 and you want to reinforce stabilization around 2. But when you're quite far away from 2%, is that the first order element of the policy strategy? And so what I would say, and what we always kind of say is, look, we're taking this kind of package approach, and there's a lot of reinforcing complementarities between pushing the deposit rate to -50 at the short end, the rate forward guidance, the QE at the long end, plus the extra help from targeted lending. When you put those together, there's quite a lot of support. Now, again, pre-pandemic, when fiscal was dealing with the aftermath of the global financial crisis, were not particularly helpful in terms of its cyclical position. Whereas now, with the pandemic and with the innovation of Next Generation EU, where there's a very significant now amount of joint fiscal effort, that is a basic I think, difference compared to pre-pandemic. And there is maybe an opportunity, an element now driven by the temporary pandemic shock, which I think if you look at what's going on in the data, the kind of until the pandemic, there's quite a lot of weight being put on the ECB basically being confronted indefinitely with very low inflation. So inflation stagnating indefinitely at 1 or below 1, or even let's say below 1.5. Now there's very little weight actually, whether it's in I think in the financial markets, in the survey professional forecasters. We now have a nice consumer expectation survey we run every month now on a pan-European basis. What's interesting, where there is a shift, and maybe it's a little bit accidental because of the pandemic, but regardless, it may be helpful, is basically shifting the distribution where those very low outcomes are essentially seen as very unlikely. Now, high outcomes are also seen as very unlikely, and it remains to be seen where these expectations will settle down. Are they going to settle down in the high ones, or really at 2%? And that's going to make a big difference, I think. Let me just come back to the unobservables that Ben mentioned, which of course they all are. But I think a little bit going back to, this is why put a lot of value or a lot of weight on outcomes. So if you put a lot of, which we say, we want to see realized progress in underlying inflation. So of course, one way you're going to back out your updated estimate of these unobservables is if you see enough wage inflation emerging. And so for us, this is going to be a very important outcome-based variable. So I think we don't have to, if we're going to be persistent, to really make sure we really are going to deliver 2%. We don't have to, have a lot of guesswork about where exactly is or start 2 years from now, whatever. We can wait.
I just want to move from, you talk about outcomes, Philip. I wanted to move to something that might be a little bit less observable, which is inflation expectations. And both Rich and you, Philip, mentioned inflation expectations when you spoke. Both the strategy review documents and the Fed's long-run goals and policy statement refers to affords inflation expectations sort of quite an important role. Rich, if I could start with you, what would de-anchored inflation expectations look like?
Well, I hope I don't find out. It would it could bear similarities to what happened in the U.S. in the 1960s when in those days we had very few. We had the Livingston survey, and the Livingston survey had been around 1.5% for almost a decade, and then between 1966 and 69 it moved to 4%. So I think there are historical episodes where even after a long period of low inflation, they can drift up. To be blunt, I think it would be a policy. It would require a systematic and persistent policy mistake relative to our avowed framework. I'm not putting, and I don't think the committee's putting all its eggs in the rational expectations basket. I think you want a robust sense. As I said, if in particular, one thing I like about the Fed's Staffs Index is that it combines market-based and survey-based and econometric model-based. Maybe one data point that's useful, probably other than Livingston, the oldest survey that's been around is Michigan, which goes back, I think, to the 70s. And there has been a pickup in Michigan in inflation expectations. But if you look at the Michigan inflation expectations 5 years in the future, so that's sort of trying to filter out the oil price and the supply shocks, it has risen, but it's basically risen to a level where it was between 2004 and 2014. So that it's useful to have some long history to sort of get a sense of those. Obviously, market-based measures, especially 5 years in the future. But obviously, inflation expectations are unobservable, but they're mission critical to what central banks do. And our focus is really on having a robust assessment on them and not taking them for granted, which gets back to what I said a moment ago about when you look at labor market indicators, it's especially important to look at prices and wages as well as quantities. There was I see Phil and maybe Ben nodding, there was a tradition in macro going back to the 60s, 70s, and 80s where there's a different regime and there was a pretty prompt pass through from unit labor costs to price inflation. That empirical relationship has weakened a lot in the last 25 years, which I think is because of the regime change in credible inflation targeting. But it's very crucial, I think, going forward that wages adjusted for productivity be consistent over the medium term with the inflation objective. Right now they are, but as I said, the labor market is, because of fiscal and monetary policy support and probably some supply issues as well, the labor market is definitely operating in a position much similar to where it was in 2017 or so than 2011 or 12. So we need to look at that very, very closely.
So let me jump in. I mean, first of all, and again, I briefly mentioned, and actually Thursday this week, there's a joint ECB New York Fed conference, I think, on consumer expectations. So I'm going to say a few words of that as well. But we have this new consumer expectation survey, which consistent with what Rich said is consumers are paying attention. So their 1 year ahead expectation has gone up. They know there's a 10, but their three year ahead has not. So again, the consumers in Europe are also assessing right now, this is a temporary increase in inflation. Now, of course, I'm trying to summarize, of course, there's lots of heterogeneity across consumers, and we care about that as well. But in terms of kind of the midpoint of the distribution, I think that's an interesting difference. But this goes back to, and again, when we think about this in model frameworks, if it's a true generalized economy-wide shift in inflation expectations, you're going to see it in wage and price behavior. So this is why it's important and the ECB came out with a paper last week, by the way, where there is predictive value into survey professional forecasters, much less so in terms of the market-based measures. I mean, the market-based measures have moved a lot for the euro area. And this goes back to this risk premium issue, which is the risk discount that inflation would just stagnate at a very low number. That's, I think, is priced out now. It's much more about that, which is welcome, compared to fears of kind of inflation being persistently above the target. So that's not really in the data. The wage outcomes for a long time were more influenced by the fact that honestly, Europe was getting used to inflation rates, around 1 rather than around 2. Of course, if that gets reset, consistent with 2% inflation, that's good news. But of course, we have to look in case it kind of destabilizes. But it's very important also, maybe the last point, going back to the pandemic, it is this year, and I'm saying true in the US, inflation's been unexpectedly high. So if you think about wage settlements in the next year or so, some element of that might be just simply catch up. I made a bad wage bargain last year. I'm going to, and it may be more so in our multi-year wage bargaining in Europe than more of the spot labor market in the US. So we may well see faster wage increases for a while, but that doesn't necessarily tell us that the medium-term dynamic has changed. So kind of working on these labor market issues, it's just going to be, it's take a fair amount of time before it settles down.
So I think we have time just for one last question. And I wondered if I could pose Ben's question on equilibrium real interest rates to you. It's what set off your strategy reviews, your framework reviews. Rich, if I could start with you, how do you cope with the uncertainty around R star and what's the Fed's thinking on that?
I think the sequencing is important. There is uncertainty about R star, but the committee at least believes that the neutral nominal rate's above 0. So whenever liftoff commences, and the history is any guide, it will be inertial. You know, the Fed is not going to go from 0 to whatever its neutral view is in one meeting. Then there will be a time when you're essentially ramping up till you get in the vicinity. When I joined the committee, actually 38 months ago, that's just as coincidence would have it, that's where we were, in that the Fed had been on a very gradual inertial liftoff. And in September of 2018, we were still below everyone's estimate of neutral on the committee and the econometric models. And then, you know, after the fact, within several months, certainly into 2019, it, you know, became clear to us that the effective neutral rate in the U.S. economy was certainly not greater than 2.5%. But we didn't know that in September of 2018 or earlier. So I think it becomes more of an issue in the interest of time, as once the liftoff commences and once you're getting into that vicinity, then you really do have to be very, very attuned. And then again, you know, I'm an international monetary economist, so it would behoove me to say, and remember, our star is whatever it is, it's a global general equilibrium outcome, you know, the savings glut and all the rest. And so countries don't have the luxury of having independent R stars as a substantial global component, and that needs to be respected as well. And I'll leave it at that.
Yeah, I mean, from my side, I agree. I mean, this is going to be more of a binding question much later in the interest rate cycle. But I would more connected about how do we think over time, especially with the pandemic, how we think the pandemic bears on the path for R star. So typically we think about demographic factors, we think about inequality, but we also think about desire for safety. And with the pandemic, which is a huge negative shock, and of course it connects right now to the high accumulated savings which households are holding on to. You know, that in Europe, we've yet to see a big dip dipping into that accumulated stock. So the savings rate is kind of going back to normal. It's not going below normal as of yet. So it looks like, you know, now, but of course the pandemic's not over yet. Now people are kind of pleased to have the opportunity to strengthen their balance sheet. And it's a big topic. Now, during the pandemic, that's being counterbalanced by governments being very willing to expand their debt levels to offset what's going on in the private sector. But again, in medium term, and here where the fiscal system is so different to the US, this is going to be a big question where savings settle down, aggregate savings settle down here, and of course that also has to be understood in the global context. So and then maybe this thing about the growth. I mean, of course, you can be optimistic with digitalization, the potential productivity gains from the acceleration of digitalization. On the other hand, with the carbon transition facing us, it's going to be non-obvious in which direction R star is going to move in the coming years.
Ben, I wanted just to get a final word from you, really. Your sort of closing thoughts on whether you think the US and the euro area can escape the effective lower bound, whether you think these reviews, these framework reviews, are sort of a step in the right direction, what you might worry about in terms of their efficacy.
Yes, I think these are definitely a step in the right direction. They maintain the target, but they have elaborated on the strategy and added ways to stay further away from the lower bound. A lot depends on how R star evolves over time. I mean, there's arguments that it might rise. We have fiscal deficits. We have perhaps increased productivity. We might have at least somewhat higher sustainable inflation, depending on as we reach targets. So that would be also constructive. We also seem to have on both Europe and the US more aggressive fiscal policies as well. So yeah, I'm hopeful that after this episode, which is a very challenging one, that these frameworks will reduce the problem. I think in very large recessions, that fiscal assistance will be necessary, that we're no longer in a world where monetary policy can take full responsibility for stabilization. But I again, I began by, I raised, I hope, some interesting questions, but I began by commending both central banks for their careful thought about how to address this perhaps most important issue that monetary policy faces since the financial crisis.
Well, both central banks have said that they'll do another review in 2025. So maybe some of us will be back here in 5 years' time talking about what changes have been made. But in the meantime, I'll hand over to David for this second session. And thank you all very much.
Thank you very much, Rachna and Phil Lane and Ben Bernanke and Rich Clarida. I sometimes think the hallmarks of a good conversation are one that you wish could go on twice as long as it did, and this one certainly qualifies. We're now going to turn to a different approach. Sometimes central banking is like watching professional sports. There are a bunch of us on the sidelines who think if they'd only listen to us, they could do it better. And so we have a very good panel, and we structured it to get different kinds of perspectives. We're going to focus more on the Fed framework from people in the markets, people in academia, and people who are veteran central bankers. So we have Julia Coronado from Macro Policy Perspectives, Bill Dudley, the former president of the New York Fed and now at Princeton, Asadal Sain, who's an academic at the University of Texas, a veteran of the New York Fed Research Department, and Tiffany Wilding at PIMCO. So I'd like to start, I think, with you, Tiffany. The central bankers argue that we have told you enough about our framework so you should be able to understand what we're doing and what we're thinking. And I wonder how you and the clients you have in the markets think about that. Do we know enough about what the Fed means and its monetary policy strategy so we understand how they will react as the economy evolves?
Well, first, thanks for having me. Obviously, this was a very interesting debate and discussion that we had with Bernanke and Vice Chair Clarida and Philip Lane. But let me just say that I think overall the Fed's communication of its new objectives, I would argue they've been quite clear. But I would also argue that the framework in large part has already been successful. And as a result, the FOMC now faces a different set of risks. And I think there are practical questions around, the implementation of that from a monetary policy perspective. So let me just expand. So I think Vice Chair Clarida's April 2021 speech, I thought was particularly useful at discussing the new framework because it talked about the shortcomings of the previous framework and it talked about the motivation for the new strategy. And in particular, he summarized it as shifting stars and the end of the copacetic coincidence, basically arguing that a flexible inflation targeting strategy could no longer really deliver long-term inflation expectations at 2% because of the low R-star world, which affords the central bank less room to accommodate in the event of negative shocks. And of course, at that time, measures of longer-term inflation expectations also appeared to be anchored below target, we would argue. Of course, in 2014, there was a marked decline across inflation, longer-term inflation expectations measures. So since that time, the new strategy, of course, coupled with a large dose of fiscal stimulus and the currently elevated levels of realized inflation, it does appear to have delivered longer-term inflation expectations that are back at target. I think Vice Chair Clarida mentioned this, but of course the Fed's measure of this, the Common Inflation Expectation Index, it's risen back up to its historical mean. We would even argue that maybe longer term inflation expectations have been a little bit more adaptable to the new regime than maybe even we thought they would be. So I think as a result, as I mentioned before, the risks that the FOMC now face have shifted. In longer term inflation expectations, the risks around that we would argue are now balanced and instead of maybe to the downside as they were previously. And I think there are key questions now as a result of that, of course, the folks on the panel before us, I think did a nice job of answering, but I think those key questions are, how much more above target inflation is now necessary given that inflation expectations look re-anchored? And how should the Fed react to further supply shocks, which maybe risk boosting inflation expectations above target And then, of course, how is the trade-off between maximum employment and price stability changed? And I think these are the questions that markets are currently grappling with when they're trying to assess the market pricing of Federal Reserve policy, as well as longer term inflation expectations. But I would say overall, I think the markets are still, providing the Fed a lot of credibility around its 2% inflation goal, in the context of the still low R-star environment.
Thanks. So Julia, do you think the Fed has explained well enough what these trade-offs are and how it will react to a situation that is actually quite different than the one in which the new framework was conceived?
So I think, the basic gist of the new reaction function, the new strategy of the fact that the effective lower bound means that they will err on the side of being behind the curve and very outcomes based rather than preemptive and forecast based. That's well understood. And even, market pricing now that's running a little bit ahead of the FOMC's baseline projection it's still sort of much more dovish than prior cycles. So in that sense, I think the market is very clear. I think one of the missing elements in the framework that gives rise to some of these potential areas of confusion is that it does focus on the effective lower bound for interest rates. And it does not bring in the fact that the Fed's toolkit isn't empty there. They do have these asset purchases. And not only the asset purchases, but in addition to the bond purchases, the Fed implemented a number of supervisory guidance tools on loan forbearance that were hugely effective in preventing defaults and sort of the second round effects that are typical in a recession, as well as these emergency lending facilities. So the Fed's toolkit isn't empty there. And in fact, maybe what we learned is that in a cycle where we're not dealing with a big debt overhang and a debt deleveraging risk, those tools can be quite effective. And so, I think, future iterations, there's this promise to regularly review the strategy. I think we need to expand it to include the other pieces of the toolkit and what we know about them and how they integrate together. So right now, the whole question about tapering, how does that fit in with interest rate policy? Are they distinct? And I think the Fed has done a really good job of communicating kind of the different thresholds that they are currently applying this cycle to tapering versus raising interest rates. So, I think that they've done a good job communicating that. I think it's reasonably clear to the market, sort of the dimensions along where the risks lie. So to the extent, I think to Tiffany's point, to the extent that, the market might be pricing earlier rate hikes than the Fed's baseline, the Fed itself acknowledges this is where the risks lie. We are facing this tension between the mandates. That is, it was conceived of. There is a clause, and Vice Chair Clarida reiterated it, as has Chair Powell, that when there is this tension, they'll take into account the magnitude of the deviations and the likely horizon over which they are expected to persist. So that makes it very important to see whether we see this broadening in wage and inflation pressures versus, which would say that's more real and demand driven versus more supply chain driven. Do we see that fading? So I do think that the communication they've been trying to be nimble and fold these unusual, unforeseen circumstances into the framework and explaining it to the market. And I think, the conversations I have with clients, those are the dimensions, those fundamental dimensions. Is inflation more persistent? Is it broadening out to say rent inflation? Are wages broader or narrow? Is the labor market tight or loose? Those are the kinds of conversations that I think the Fed wants market participants to be grappling with, to feed it into the framework. So I think it's reasonably clear there's no way you're going to delineate, concrete metrics given the complexity of the global economy, given, so I don't think that the framework was that ill-suited to the current circumstances. It does require an added dose of, okay, what are the dimensions that we're going to be looking at to make these difficult judgments when there is this tension?
Thanks. Bill, it seems to me the risk here is that the Fed elaborated a framework at a time of below target inflation, very low interest rates. It's sort of, we all expected that to persist. And now I think the risk is that they've boxed themselves in, and it'll make them too slow to react to an economy which may be quite different, one that's more inflation prone. How do you look at the world?
I agree with that as a risk. I think the move to 2% average inflation targeting made sense because you want to keep inflation expectations better anchored around 2%. So I have no quarrel with this shift in the long-term monetary policy framework on inflation. Where I think there is a possible risk, though, is the three conditions that they imposed now for actually raising short-term interest rates. As Vice Chair Clarida pointed out, you need three conditions. Inflation has to be at 2%. You have to be confident it's going to be above 2% for some time in the future. And you have to be confident that you're at maximum sustainable employment. So that means a big contrast of monetary policy this cycle compared to last cycle. Last cycle, the Fed was essentially trying to arrive at a neutral monetary policy setting at the same time they arrived at 2% inflation and full employment, sort of a soft landing. This time, they're not even going to start to raise short-term interest rates until they're actually at or beyond full employment. So I think this has a number of important implications that I don't think have fully sunk in. Number one, it means that the Fed Reserve is going to be behind the curve. And so once they recognize that they're beyond full employment and they have an inflation problem, they're going to have to move faster. Second, they're going to have to do more because remember, inflation now is higher. And they also have to push monetary policy not to neutral, but to a tight setting. And number three, there's much more risk of a hard landing. The Fed's ability to push the unemployment rate up by, say, 0.5 percentage point and avoid a recession is essentially non-existent. There's never been an example in US economic history since World War II where the Fed has been able to achieve a soft landing from below, where they push the unemployment rate up a bit. What happens is once the unemployment rate starts moving up, almost always you get a full-blown recession. I think the problem that they have is exacerbated, as you mentioned, by the current economic environment. It's very unclear where full employment is. They're missing badly already on the inflation side. And there's a risk that inflation expectations could become unanchored, even if the inflation factors today turn out to be transitory. If we have high enough inflation for a long enough time, it's possible that people will start to lift inflation expectations, even if the factors that cause that turn out to be transitory. And lastly, they've sort of locked themselves in with the taper. The taper is not going to be complete until the middle of next year. And they've basically said that they can't raise interest rate until the taper is complete. So yes, they could accelerate the taper, but accelerating the taper is very, very difficult because the whole focus of policy has been to avoid a taper tantrum. What do you think would happen if the Federal Reserve tomorrow announced that they were accelerating the taper? Not only would people be much more confident that the Fed was going to lift off immediately after the taper was finished, it would be an admission by the Fed of a policy error. So the fact is, not only is the Fed potentially even late today, they could be much later by the time we get to mid-year.
Well, thanks for that encouraging remarks, Bill. I think now that you're in academia at the University of Texas at Austin, you've done a lot of work on this maximum sustainable employment leg of the Fed's dual mandate. I think that sometimes gets overlooked when we focus so much on the current inflation situation. But I wonder is it significant that they've changed the way they look at maximum employment? And how much of that do you think will restrain them, as Bill suggests, on the day of tightening?
Thank you, David. It's great to be here and see my former boss, of course. So I looked at Chair Powell's press statement a couple of days ago. The phrase price stability appeared 8 times in questions and answers, while maximum employment appeared 29 times and full employment another 4 times. So it's clear that this is now well-defined and there are lots of questions. So when I look at the way they defined it, when there is no trade-off coming from the inflation side, they meant that they are not going to respond to a hot or tight labor market. So this is relatively easy to understand when there is not much trade-off. But there are 3 key phrases that make it very hard for the public to understand what they mean by maximum employment. The first one is the new addition, broad-based and inclusive. That is not directly measurable. So not only we don't have a clear measure like EPOP or payroll growth, we also have the dispersion of this unspecified level. The second one is they are going to assess progress towards this unspecified level or measure by looking at a wide range of indicators. So we were already looking at a wide range of indicators, but now we have to think about the dispersion across the population of these indicators. The third one is this level, even though we don't specify it, it varies largely due to non-monetary factors. So you will have to then think about what fraction of each of these indicators the Fed can influence, which part, as we call it in central banking, cyclical versus trend. So these are the difficulties as an academic to parse out what they mean. But then what did the public take out of this? The Fed was very clear in communicating that don't only look at unemployment. We heard a lot of this today. Don't only look at wages. We have a holistic view of the labor market that we are going to evaluate when we want to understand where the maximum employment is. So this created, I think, 3 different ways of looking at the labor market. The dashboard approach, which is very hard to aggregate, even for experts. The second is labor market conditions index. Kansas City Fed has one, San Francisco Fed has one. The Fed board used to have one, but they had to discontinue it because of detrending methods and changes in series. So there is some issues in trying to tie yourself to a certain index. And then what the public did is they decided that they are going to look at pre-recession levels of key indicators, EPOP, LFPR, payroll as their benchmark. Of course, when we know that there are other factors affecting the economy, this is a very dangerous benchmark. And I think this is where we are right now. When you look at the questions asked to Chair Powell, they're always trying to understand, is it minimizing the maximum unemployment of this group versus that group? Is it the participation rate? And then which fraction is trend? So I think there's still a lot of room to improve communication on the maximum employment side.
Thanks. Julia, I wonder if you could respond to that. Do you think that people understand what they mean by maximum employment? And do you think it's important that they parse the measures as Asael pointed out? Or is that just a second order question? You're on mute, Julia.
Got to have one of those in every appearance.
I'm going to get a t-shirt made for the pandemic reunion, and it's going to say, you're on mute. The most uttered phrase of the pandemic.
The year of the word of the year. Yeah, so I think that more, I agree with Asegol that more clarity could be useful, actually. And I think there are a few benchmarks. Actually, her research, I think, has been extremely useful in delineating some of those benchmarks. I think what I take from the paper that she presented at the Jackson Hole Symposium is that we over-focused on the unemployment rate at the expense of the labor force participation cycle. And because of that, while broad-based and inclusive doesn't fold into employment population ratios, labor force participation does. So at a minimum, we can rotate away from the unemployment rate as some kind of, summary statistic towards employment population ratios for prime age workers. I think there's broad agreement on the committee and in the academic and Fed watching community, market community, that's a good benchmark of a strong labor market where you see the unemployment rate decline, you see participation improve following that. And so you can set that as, policy. Definitely one thing broad-based and inclusive means is you do want to, at a minimum, give some space for that recovery to happen because we know it's lagging. So you don't want to jump the gun on full employment using the unemployment rate. You definitely need a broader measure. So at least rotating to something specific that people can watch. Again, necessary, maybe not sufficient condition for policy calibration. But I do think just saying we look at a lot of measures it's too broad, it's too vague. I think Vice Chair Clarida just gave us another one, which Chair Powell has also been mentioning lately, which is productivity adjusted wage growth, right? Unit labor costs, productivity adjusted wage gains, our wage gains. Because, for example, we've seen great productivity. We're seeing higher inflation. So we should see wage growth that is above the prior cycle because we're doing better. So you don't want to just look at nominal wage growth. You want to look at these measures adjusted for productivity and inflation and look at what real wages are doing. So I think that's useful also. Unit labor costs, the labor share of GDP, the prime age employment population ratio. I think that those should be brought into more specifically. These are the things we're looking at. If they show certain patterns, then we'll need to respond one way or the other. And I see a lot of Fed officials moving in that direction, and I think that's quite useful.
Tiffany, Bill Dudley made a pretty strong case, and it's one I've heard from some people in the markets, that basically they're going to wait too long to tighten, and that we should be preparing for a period of more than the moderate overshoot of inflation for some time. And then the risk is, of course, the Fed reacts by raising interest rates and tumbling us into recession. So I have two questions for you on that. One is, how much do you worry about that? And two, is this something that PIMCO clients worry about, or is this just Bill Dudley fighting the last war?
Let me maybe first start off by talking about our clients. I think overall the volume of questions that we've gotten on inflation and on our inflation-linked products has certainly accelerated, since maybe the beginning of this year. And if you look at measures of inflows into, tips or commodities-based funds, for example, they have accelerated. So I think market participants are, what I would call moderately worried about it. I think what they're waking up to realize is that, maybe they're, from a diversification perspective, that their, the insurance against higher inflationary outcomes that they have in their portfolio is low. One place, in particular that I would just highlight on this is many target date funds, for example, have a very low allocation towards tips. Even the target date funds of the cohorts that are retiring, within the next several couple of years. And I would argue that having inflation expectation or having inflation protection within those portfolios is very key, because the high fixed income allocation in general of those near retirement type of target date funds. So I think overall it makes sense that investors are sort of rightly thinking about this in terms of their broader portfolios. But again, I guess I would just highlight that even despite that, the market, if you look at tips break-even measures, for example, the 5-year forward, of course, the one that Fed likes to look at, it does look still relatively anchored at 2%. So there's not a lot of inflation risk premium, even though we're hearing it anecdotally that markets, are pricing in. I think, and that just, I think that just speaks to the credibility of the Federal Reserve. Now maybe one other point I would make on this is that I do think where markets, interestingly, are pricing in risks of elevated inflation, how they're positioning their portfolios from that, is actually to sell the front end of the interest rate curve. In other words, they believe that maybe longer term inflation expectations aren't really going to be that great of a hedge for me, because I think the Fed is going to react to it and raise rates. And maybe they'll have to raise rates by much more than markets are currently pricing. So I think that's why you're actually seeing term premium in the front end of the curve, and on a risk neutral basis, for example, the markets are sort of implying much higher probability of the Fed lifting off interest rates and hiking, than maybe we or other, consensus economists think.
Bill, there was a little bit of discussion of R star in the previous panel. That is the interest rate that people predict, not knowing, that will prevail when the economy is calm and full employment and price stability. R star has been coming down for, as best we can tell, for a number of years. I'm curious, A, how useful a concept is this, given how hard it is to define? And secondly, how do we think about R star, the equilibrium interest rate, in an era of just huge increases in government debt? I mean, you'd think that would have eventually some effect on pushing up the neutral interest rate. In fact, Ben sort of suggested that might be welcome, because it would make it easier for the Fed to maneuver.
Well, first of all, I don't think R star is a very useful concept, because it's an unidentified variable. Number two, I don't think it's a very good concept, because the monetary policy works through its effects on financial conditions, not through short-term interest rates directly. So if the linkage between financial conditions and short-term rates is, pretty flexible, just focusing on R-star is missing, the forest for the trees in terms of what actually happens to financial conditions. What's so striking right now, of course, is that financial conditions are extraordinarily accommodative when you look at the level of the stock price, the level of bond yields, the narrowness of credit spreads. And I think the way I think about monetary policy conceptually is the Fed is going to have to at some point tighten financial conditions considerably. What we don't know is how much short-term rates are going to have to rise to accomplish that mission. Financial conditions, I can't imagine financial conditions, 2 years from now to be anything like what we're seeing today. What's interesting about markets right now is markets are not very worried about the scenario that I outlined. The amount of policy tightening priced in is pretty modest. I mean, the peak in the federal funds rate, as you look out, 4 or 5 years in the Eurodollar futures market, is around 1.5 to 1.75%. That would be the lowest peak in an interest rate cycle going all the way back to the 1950s. So even in the 1950s, we got to higher peaks than that. So the market is not at all worried about there being an inflation problem, not at all worried about how the Federal Reserve is going to have to respond aggressively to make monetary policy tight. The reason for that, I think, is because that's not today's story. Today's story is we're tapering, and we're going to be tapering for the next 7 or 8 months. And so that's a story that's sort of over the horizon. Markets are very focused on the next thing. It's to quote Keynes, it's a beauty contest. It's not about what I think will happen. It's what I think you'll think will happen and how you're going to act. And I think the markets right now are just not focused on what's going to happen when the taper is complete.
But why are long-term rates apparently failing to respond noticeably to this huge run-up in government debt?
Well, I think there's 2 reasons. One, the Federal Reserve has taken a lot of that government debt off the private sector's balance sheet, right? I mean, the amount of QE the Federal Reserve has done is enormous, and it's not done yet. So that's number one. And so I think that's very, very, very important. Other than that, though, I think QE is more powerful than people think. And I think the reason why I think QE is more powerful than people think, it's not just taking the assets out of the private sector balance sheet. It's also the fact that you're increasing the amount of reserves in the banking system. You're forcing people to hold deposits in the banking system that they don't want to hold, earning zero. And so this pushes people to look for yield, and that then feeds out into all risk assets. That's why I think financial assets, are so valuations are so extreme right now because of QE. QE is basically forcing people, who don't want to hold deposits in the banks to go out elsewhere and look for yield.
Asagel, how do you read the labor market now? Do you think that we are it's sort of confusing. On one hand, there's help wanted signs in every store I walk by, at least in the District of Columbia. There's all sorts of anecdotal reports about labor shortages. The job opening status support that. On the other hand, we have a lot of people who are still on the sidelines of the labor market. And there's some complaints that, people say they want to hire, but when I apply for a job, they're bait and switch. They don't really want a full-time person. They want me to work part-time. So I'm having a hard time figuring out, is the labor market really tight now? Is there a possibility that over the next 6 months, we'll pull in a lot of people from the sidelines of the economy and we'll discover that we can run an even hotter economy? Or is that just naive, or we're going to see wage inflation that more than the productivity would justify?
Thank you, David. The labor market had a big up and down in early 2020. And it was a very unusual period with a lot of people on temporary layoffs, and most of them went back. So now we are in a labor market that looks like the labor market pretty much in 2017 or late 2016. So by traditional metrics, it's actually pretty tight. Unemployment rate is in mid-4s. And when we look at different indicators, almost all of them are at their 2017, 2018 levels, except for one, which we have been talking a lot about, and your question was about that. What's happening with the participation rate? There was a quick reversal of the exits, partial, after the lockdowns ended. But we are not seeing this inflow of workers. Vaccinations didn't do it. Schools open, that didn't do it. And my guess is we are never going to see this big entry into the labor market. The reason is people took their time off from the labor market, and now They have a different work-life balance, and they will come at a pace that they prefer to. And what the Fed should be doing is to make sure when they come in, there are job opportunities. So ultimately, wage growth, participation, labor force attachment, they're all related to how many job opportunities out there. And when I look at that metric, the labor market is doing pretty well. And what we have seen with my co-author Bartolome in our Jackson Hole paper is that an empirical regularity between the unemployment rate and participation rate is participation rate always lags. And that's not because sideline workers enter, it's because workers who enter through employment, and the ones who are holding short-time jobs are able to create employment stability. And this is going to happen, but at the job finding rates and vacancy rates that we are seeing, we don't have to wait for this to happen because this is already baked in the cake with the conditions that we are seeing in the labor market. So this is my holistic view of the labor market.
And when you look at the wages, how would you describe what are happening to wages now? And what would make you think that we're overheating, that we've run the high pressure economy experiment and we've now gone to, I don't know what's beyond high pressure, the steam engine blows up or something. I'm running out of metaphor room here. So what's happening how do you look at what's happening to wages now? And what would be a warning sign that the Fed was waiting too long?
So what we are seeing is definitely healthy wage growth, and different indicators have different slopes, but we are seeing some wage growth, so that's for sure. But let's remember that this was also a labor supply shock in willingness to work, also a health shock that's more persistent for some workers than others. So it's only expected that this is raising reservation wages of workers. And we see that in a New York Fed survey of consumer expectations, that reservation wages started rising in 2018, and they continued this rise throughout the pandemic. So that's what we are seeing right now. Part of it is coming from the fact that this is a labor supply shock. And the other part is, as you mentioned, there are many vacancies, and we are trying to fill those in. There's a lot of competition, and this is a healthy labor market. And what is really telling me that this is happening is the unemployment rate, because it is influenced by the big reduction in job destruction and the rise in job opportunities. But the others are following this because they are all driven by the same mechanism of increased employment opportunities that creates new jobs and employment stability for workers who are subject to more turnover.
I see. Julia, there is always a lot of uncertainty about the future in the economy. I'm waiting someday for the Federal Reserve speech at Jackson Hole about making monetary policy under conditions of certainty. But there's what's going to happen to COVID. There's questions of geopolitics and all that. But one element of uncertainty right now is we don't know who President Biden will choose to for the new Fed chair. Will it be reappoint Jay Powell or go to somewhere else? And I wonder whether you think that is a problem as we navigate this very tricky moment of monetary policy where the Fed is implementing a new framework. As you pointed out, they're tapering, and we don't really know for sure how QE works and so forth, and the points that Bill made. Is this an unnecessary level of uncertainty? I would argue yes. I want to know how big a factor that is in understanding what the Fed will be doing 6 or 9 months from now.
I don't think it's a huge problem at the moment. I think, one reason that's the case is because tapering is, largely pretty preset, right. Barring big surprises in one direction or another, we know what's going to happen through June. And then the question is what happens beyond that. So, there's a lot of different views about that, but it's not a very immediate issue, and we're going to get lots of information between now and then. So it's not a really front burner problem for making expectations. Two, I do think the framework does provide, there's a lot of judgment within the framework, which is why personnel matters. But we do have a basic framework, and then we look at who the candidates are, and if it's Governor Brainerd or if it's Chair Powell, they're actually quite similar, and I think, I don't think most market participants see a lot of daylight between them in terms of their monetary policy positions. or their view of the labor market or their view of inflation. They both tend to be more on the dovish side of the committee, but also neither of them would, ignore inflation if it is broader based and more persistent. So I think that even though there's a big question over who will lead the committee, the leadership won't look that different under one scenario versus another. It will also matter what other pieces are put around them. Who are the two vice chairs? Who are the Reserve Bank presidents and the empty seats? All of that will matter. But the big decision is who will be the chair. And the two leading candidates, they're pretty similar in approach.
Okay. And Tiffany, finally, a question to you. When we framed this originally, the question was, is the Fed's framework well understood? I wondered if you could, if the Fed would tell us something that they haven't told us so far, if you could get, the lie detector test on the FOMC, what is it that you wish they would tell us that would make it easier to understand what they're doing and make for a smoother transition to the next phase of monetary policy?
Well, this is something I alluded to in my introductory comments as well. But I think understanding how much more above target inflation they're willing to tolerate, in the context of the currently high inflation that we're seeing and what appears to be inflation expectations that have re-anchored at their target. I think that would be extremely useful. Now I think they've talked a little bit about this, but overall, I think that the so-called averaging period was left quote fuzzy when they were devising this target, because ultimately they didn't know how much above target inflation they would need in order to re-anchor inflation expectations. So now that they are re-anchored, I do think there's less need for more above target inflation, but I don't think that, they've sort of come out and communicated that directly, because that obviously would I think imply a change in sort of near-term policy expectations relative to what the statement says, for example, maybe even relative to what markets are pricing in, or maybe markets are already pricing this in. But that would be my question.
I see. Thanks. I think we're out of time. I want to thank Julia, Tiffany, Bill, and Asegal for a very lively discussion. And for those, we got some questions online. I tried to fold most of them in. I didn't get them all, so I apologize for that. And this video will be archived on the Brookings website, so you can watch it over and over again, or you can watch it at 1.5x if you prefer. But thank you all for this. Stay safe, and I look forward to the suggestion that was made earlier that we regroup in 5 years so we can really know whether the framework was a disaster or not. So have a good day.
Thanks for watching. Be sure to like and subscribe for more videos from Brookings.